short squeeze in the VIX. So the VIX has gone up almost 100% in just the last 2 days. This is an enormous move. The VIX is above 19 when I'm recording this live stream show. It's at 19.32 as of right now. It's up 25% alone today. And for a historical perspective, the VIX at these levels, this is the fourth largest 2-day advance in volatility in the last 5 years, and it was only exceeded in February 2018, October 2018, and August 2015. And that's from a trader who I follow on Twitter, who follows these. He's a CMT certified market technician. Well, I remember the funny thing about the VIX is I remember it seemed like only a couple days ago, but it was actually around April 26th or 27th when I did another short video. And it was because of a Bloomberg article that hedge funds are shorting the VIX at a rate never seen before. So remember, I was talking also about this leverage short volatility trade. Christopher Cole of Artemis Capital, he is a professional volatility trader. He's one of the few people that actually has a hedge fund, and all they do is set up volatility trades. They don't do direct stuff with the VIX. They do a bunch of different trades with volatility. And he was saying that the leverage short volatility trade specifically for the VIX, this was 2 years ago, he was saying was at $1.5 trillion with leverage. And I can imagine, based on the news that we got on April 26th with hedge funds shorting the VIX at a rate never seen before, that number had to be much, much larger and with even more leverage. And when you have that much leverage in a market, and I'm using air quotes, in a market, you don't need big moves. So you don't need the stock market to crash 20, 30% for bad things to happen. When you have that much leverage, bad things can happen with 3%, 4%, 5%, less than 10%. And I'll give you an example of this, because when you were Lehman Brothers and you were leveraged 40 to 1, your balance sheet was leveraged 40 to 1, you only needed asset prices, because you had that much debt on your balance sheet, you only needed asset prices to fall about 2.5% before Lehman Brothers was in big trouble. And Bear Stearns was leveraged 60 to 1, I believe. At the before the 2008 financial crisis, they got as high leverage, I think, as 60 to 1. So they needed even less than that. It was 1.5-ish, a little above 1.5%. So a 1.5% drop in the assets on their balance sheet that they were holding, in the assets, I'm using air quotes, because who knows if they're actually being honest and marking them to market back then. Even now that the banks, remember in March of 2009, the FASB changed the laws, and the banks don't have to mark things to market anymore. So when you have that much leverage, it doesn't take a big drop in the asset prices for problems to happen. And when the VIX, when there was, the stock market getting spooked with the China trade deal and Trump doing, or lack of trade deal, and Trump, threatening the tariffs on Cinco de Mayo on Sunday with 2 or 3 tweets, and now China, because Trump showed them some strength, you could potentially, because of the total amount of leverage in the system. I guess there's no one in the live chat here yet, which is surprising. Probably not getting any notifications because YouTube doesn't want me here. But anyway, I'll keep on going. When you have that much leverage, whether you're a hedge fund, a bank, etc., if you're leveraging your own balance sheet that much, it does not take a large move for you to get a margin call, for you to be in trouble. And so it looks like we are having a short squeeze here from either some hedge funds or some institutional level traders. And from my sources, and I've spoken to different people about this, I've listened to pretty much all the Christopher Cole interviews from Artemis Capital out there. I've spoken with Grant Williams about the leverage short volatility trade, and there's a really great conversation. It was from one of either the last or the second to last episodes of the Adventures in Finance podcast that Real Vision TV ended for free over a year ago. And it was just Raoul Pal and Grant Williams going back and forth, and they were discussing at length central bank currency swaps and the leverage short volatility trade, and they were discussing their conversations with some of these institutional money managers. And normally these institutional money managers are supposed to be very, very conservative, but these guys need income. They need to produce some results, and they just weren't getting it. So these guys who normally would have been more conservative, they were either giving money to hedge funds to do some of these riskier bets, or they were doing them themselves. And betting on the VIX with leverage, like shorting the VIX with leverage, even though there might be central banks or plunge protection teams in on this trade, and it's a very overcrowded trade, as I was talking about after I talked about that Bloomberg article, extremely overcrowded shorting the VIX. A lot of professional managed money is shorting the VIX and shorting other assets with leverage, probably also shorting gold and silver too. Some type of leverage short volatility trade as well. Probably that's set up there too, because Grant Williams and Raoul Pal were discussing how the leverage short volatility trade has moved from the VIX into other asset markets as well. So it's not just stocks anymore, it's commodities. They're using options and trying to collect premium by selling basically naked calls with leverage. Very dangerous parts of trades. Very, very dangerous trades in order to pick up. It's the equivalency of like trying to get loose change on a freeway, pennies in front of the steamroller. You can pick your analogy however you want to call it. But if Christopher Cole is right about the amount of leverage, and it's even larger now than it was a couple years ago, so it's larger than $1.5 trillion with leverage, there is going to be at least one long-term capital management out there. But we're in a system now with moving goalposts and rules changes and covert bailouts, backdoor bailouts, where they're not even announced, that we may not even know about it. We may never find out about it, which is sad. I'm in favor of truth, honesty, transparency, trying to find the truth. You guys know that I will change my opinion if the facts change. So it's very interesting what is going on with the VIX. One more thing I wanted to bring up with the exactly jet leverage is, well, leverage is very dangerous. I wouldn't call it disastrous. So if you're a rental property owner, right, and you have good rent to value ratio and you have positive cash flow in your rental properties, that is probably a good way to use leverage, okay? That's a more conservative way as a rental property owner. It depends how you use the leverage. It depends how you use the debt. Not all debt is bad. Talk to a real estate rental property investor who smartly uses debt. Okay? Now, 2008 hurt a lot of rental property owners, but it has come back. So rental properties over the long term are normally considered very safe, even when there is a stock market crash. And again, this is not financial advice, I'm just talking historically. Banks will eventually start giving out loans to rental property owners. So there's a difference. It depends what you're using the debt for. So let me just talk about, I'm looking at a chart of the VIX now. I have up, let's see here. It's a 5-year chart of the VIX. And the VIX got as high, remember that Christmas Eve, the stock market crash? The VIX, I need some water. My lips are getting parched. The VIX got as high as 36.07 on the Christmas Eve. And remember, Steve Mnuchin back then came out, and there was that weird press release with the plunge protection team, and there's no liquidity problems. I honestly think, and speaking to some of my sources and listening to podcasts from other experts, like people who actually worked at Lehman Brothers, like Jared Dillon of the Daily Dirt Nap and others, and his theory is that there actually was a liquidity problem with one of the banks, that there actually was. One of the banks was actually in big, big trouble when the stock market started going down then. And it could have been because they were trying to be too greedy and had leveraged up and were trying to make money off that leverage short volatility trade because they were trying to pick up extra cash. Maybe they gave out too much money to hedge funds. Maybe the bank was acting like a hedge fund. In a lot of cases now, the banks do. Although with the Volcker rule and some of the other stuff, the banks are not supposed to not be able to do that, but we always know the banks always figure ways around that. So the theory was that the press release was really a wink, wink, nod, nod to the bank out there. I'm not educated guess. I have a couple educated guesses about who it could be, but I don't want to say it in public. Okay, because I think there's something that may tie into it, like political events and protests that have been going on for a while now. So that may be there may be some connection there. But I think there was actually a liquidity event on Christmas Eve, and that's why Steve Mnuchin issued that press release, and it was sloppy. Rather than him doing phone calls and doing things covertly, he issued the press release overtly to make sure the bank that was in trouble would see it. So he didn't want to leave anything to chance. He wanted the bank or counterparties of the bank to see out in public that there is no liquidity event, things are getting taken care of. But the chart of the VIX had been going up for months until this Christmas Eve of 2018. And it did have a little bit of a rally on January 3rd to 25-ish. And since then, it's been very little rallies. It's been lower highs and lower lows, and just in a pretty big downtrend with a couple small rallies that just get hammered back down. There were a couple attempts to break out where it got to a little under 17 on the first week of March, and it got to 1648 towards the end of March, on March 22nd. But other than that, the VIX had not done much. And that is because there is a lot, like I said, a lot of hedge funds, a lot of institutional investors. And by the way, guys, these institutional investors in their bylaws, they're not supposed to be doing this leverage short volatility trade. And yet, because other people are making money off of it, it's either they're greedy or it's career risk, and they're trying to do it anyway. Okay, guys, well, that's it for right now. Bye.